Today, we're focusing our lens very, very tightly on one specific financial zone.
Yeah.
The Colorado homeowners insurance market. And we're talking about right now, 2025, 2026. This isn't just a general chat about, finding a decent rate.
Yeah.
This feels more like a necessity. Our mission today is to cut through all that noise about rising premiums and show you where the real financial danger is, especially if you're trying to navigate this market alone.
And look, we have to start with the tough truth.
Yeah.
If you own a home in Colorado, you are operating in what the industry has now sort of quietly categorized as a Tier 1 catastrophe zone.
Tier 1?
Tier 1. It places us right alongside the most volatile markets in the country, like California and Florida.
Wow.
And that's not me being hyperbolic. That reflects how insurers are behaving. The grim reality is this. If you haven't really dug into your policy, your coverage limits in the last 2 years, you are almost certainly exposed to massive financial gaps.
Gaps that could bankrupt you.
That could absolutely bankrupt you in a total loss.
That's a pretty no BS way to start, and I appreciate that. But let's define this Tier 1 status. I mean, we all know about the wildfire risk, right? Especially after the Marshall Fire. But what else is driving this?
It's what we call the dual catastrophe nature of our risk.
Catastrophe.
Yeah, the rest of the country sees California and just thinks fire state. They see Florida and think hurricane state. They look at us and they see a fire state and a hail state.
Right.
Colorado has this unique and very costly challenge of dealing with both wildfires, especially along that wildland-urban interface where so many people live, and these severe convective storms. The hail.
So the hail is what drives the day-to-day statewide losses.
Exactly. It's the core driver of premium cost across the entire state. The data proves it. I mean, since 1980, Colorado's had more than 76 separate weather disasters that each caused over $1 billion in damage.
$1 billion.
$1 billion. And the hail losses specifically drive like 60 to 70% of the premium costs across the entire Front Range.
And the consequence of that constant, costly claim environment, is now hitting everyone's wallet. It's making headlines.
It's a seismic shift. I mean, the data from the National Association of Insurance Commissioners it's staggering. Average premiums in Colorado are up 58% to 65% in just 5 years.
58 to 65%.
Yeah. We are now officially one of the top 10 most expensive states for homeowners insurance. Even Governor Jared Polis has called the cost and the availability issue a major crisis.
So in this environment, the old way of doing things, just shopping for the cheapest rate online.
It's financially reckless. It truly is.
Okay, let's unpack that for the person listening, because their pain point is that renewal notice.
Of course.
They just saw their rate jump 40%, maybe more, and their first instinct is, I have to cut costs. So why shouldn't I just go online to a direct carrier I see on TV and shop for the lowest price to save, $200 or $300 a year? Price is the only thing that matters right now, isn't it?
That is the most common and, frankly, the most dangerous way people are thinking right now. And I get the rate shock, I do. That's just the market. But the real danger isn't the rate itself.
Okay.
It's the fine print they've tucked inside that expensive new policy. You might think you're saving money, but you could be paying 40% more for a policy that still has a 2% wind or hail deductible hiding in there.
Wait. 2% deductible. If my house is insured for, let's say, $500,000, what is that? That's a $10,000 deductible.
It's a $10,000 bill waiting to happen the moment the next big hailstorm rolls through.
Wow.
So that $300 you saved on the premium just cost you an extra $9,700 out of your own pocket. It's why we always say value over price.
Right.
I would so much rather explain the cost of proper coverage now before something happens than try to explain why you aren't fully covered after the fire.
But is that even legal? I mean, are carriers allowed to advertise what looks like a standard policy but basically hide a $10,000 deductible in the fine print? How is anyone supposed to catch that?
It is legal, and it's a symptom of what we call the hard market.
The hard market.
Right. The carriers aren't necessarily being predatory. They're trying to survive in a market where they're consistently losing money. Colorado has the 4th highest 5-year loss ratio in the entire U.S.
So they're just bleeding cash.
Constantly. And when an insurance company is losing money, they have 3 options. Raise rates, shrink coverage, or just stop insuring homes in that area. And right now we're seeing all 3.
So the hard market really just looks like instability, carriers pulling out.
Precisely. They are shrinking their exposure, their overall risk. There was compelling data from 2022 showing that 76% of carriers outside of the Big Five actually reduced the number of homes they insured. They just issued non-renewal.
And that's not just in the mountains.
No, the instability is across the board. The ripple effect is huge.
And this leads to those insurance deserts we've been hearing about.
Absolutely. We have specific concerning examples. Allstate, for one, has made certain zip codes in places like Boulder, Nederland, and Broomfield completely ineligible for new business.
So they just won't write a policy there.
Won't write it, period. And that puts immense pressure on the carriers who are left, which drives up the cost for everyone and makes it so much harder to find good comprehensive coverage. When you have fewer choices, you pay more for less.
So the high rate, that's just the symptom that gets our attention.
It's the fever.
Right. But the true disease, the real financial catastrophe, is this massive underinsurance problem that's being created.
That is the critical insight. You have to understand that. And the Marshall Fire, it gives us the clearest, most chilling case study of what happens when a policy looks fine on paper, but just completely fails in reality.
I remember the scale of that disaster. It was just horrific. The physical loss and then hearing about the financial struggle afterwards.
The findings from after the fire were terrifying for any homeowner in Colorado. Research from CU found that an estimated 74% of the policyholders affected by the Marshall Fire were underinsured.
74%.
And worse, 36%, over a third, were severely underinsured. That means their policy covered less than 75% of the actual reconstruction cost.
That's not a fringe problem. That's a market failure.
It is the standard operating condition in Colorado right now, and it's almost entirely due to something called the valuation gap.
The valuation gap.
Take the story of Manu Sapti in Superior. He was paid what he was owed right up to his policy limits, but he still spent $1 million more than his insurance payout just to rebuild his home and replace his stuff.
$1 million out of pocket.
He wasn't cheated. His policy limits, which were probably fine a few years before, were just fundamentally inadequate for the reality of rebuilding in 2022.
And that brings up the core confusion. I think every homeowner struggles with this. The difference between market value and what you're calling replacement cost.
Right.
Most of us think, my house sells for $800,000, so I should insure it for $800,000.
And that assumption is a critical financial error here. Market value is what the home sells for. It includes the land, the location, the view. It's driven by real estate demand. You can't insure land.
Okay.
Replacement cost, or what we call reconstruction cost, is the actual money needed for labor, materials, debris removal, and this is crucial, complying with modern building codes to rebuild the physical house from a hole in the ground.
And here in Colorado, and a lot of desirable areas, that reconstruction cost isn't just different from market value, it can be higher.
Oh, absolutely. The cost of specialized labor is through the roof, especially after a disaster. We see construction costs hit $400, $500, even $600 square foot in some mountain towns. Your policy has to be based on that high, volatile reconstruction cost, not what you paid for the house 2 years ago.
Okay, I'm convinced. Chasing the cheapest premium is self-sabotage. I get the macro risk, the hard market, the underinsurance. So let's get specific. If I'm looking at my policy, what are the exact fine print traps a DIY shopper is guaranteed to miss?
There are 3 critical gaps that define a substandard policy in this market, and they are all deliberately hard to find.
Give me the first one, the one that got my attention earlier.
The deductible traps. The old standard policy had a nice, clean, $1,000 deductible.
Right.
Today, nearly all carriers here have shifted to percentage deductibles for wind and hail. So you might look at the first page and see $1,000, all other perils deductible.
You think you're safe?
You think you're safe, but you dig 3 pages deeper and there's a separate 1% or 2% deductible that specifically applies to wind or hail.
So on my, say, $450,000 of dwelling coverage, a 2% deductible means I'm paying the first $9,000 for a new roof.
A roof you thought would cost you $1,000. It's a massive financial hole.
And hail is our biggest source of claims.
It's the one you were most likely going to use.
Okay, what's trap number 2?
The cosmetic exclusion. This one is insidious. It focuses on hail dents on your metal roof, your siding, your gutters. This is an endorsement that lets the carrier deny payment if they decide the damage is just cosmetic.
Meaning it's not leaking yet?
Exactly. They say it doesn't compromise the structural integrity. So if the hail makes your house look battered, but the roof is still technically functional, the insurer can just walk away.
That seems outrageous.
It's terrible, but it's becoming common. Here's a real-world scenario. You get some hail damage, not enough to file a claim over that huge deductible. A year later, you decide to sell your house.
Okay.
The buyer's inspection flags the dented roof. Because of that cosmetic exclusion, your own insurance carrier denies the claim. You, the seller, are now forced to pay $20, $30, maybe $50,000 out of pocket for a new roof just to close the deal.
It completely shifts the cost onto the homeowner at the worst possible time. And I'm guessing that exclusion is labeled something tricky.
Exactly. Something like cosmetic damage exclusion roof surfacing. An easy line item to miss when you're skimming 50 pages.
Which leads us to the third big gap. This connects right back to that catastrophic Marshall Fire scenario.
Yes. Insufficient ordinance or law coverage. This is mandatory today. If your older home burns down, you can't rebuild it the way it was.
Right, you have to rebuild to current code.
Current code, energy efficiency, fire-ready materials, updated electrical. All of it.
And those upgrades are incredibly expensive.
They can easily cost $150,000 or more here, yet a standard cheap policy might only give you 10% of your dwelling coverage for these upgrades.
So on a $500,000 policy, you get $50,000 for code compliance.
Leaving you with a $100,000 hole you have to fill yourself. This is why we push to increase that limit to 25% or even 50% where we can. You have to look for that number.
So the private market is contracting, creating these huge gaps. I know Colorado started the FAIR plan for people who get non-renewed. Is that a real solution here?
The FAIR plan is a critical safety net. It's for people who've been denied by 3 other carriers. But, and this is important, it is fundamentally not a solution for the typical Colorado homeowner.
Why not?
2 main reasons. First, it caps coverage at $750,000. For most homes on the Front Range, that's immediately underinsured. Second, and this is the most critical part, it only provides actual cash value coverage, not replacement cost.
And actual cash value means they deduct for depreciation.
Exactly. Your roof is 10 years old on a 20-year lifespan. They'll only pay you half the cost of a new one. To fix that, you have to go buy a separate policy called a difference in conditions policy to fill that ACV gap and get liability coverage. It's complex, it's expensive, and it should only ever be a last resort.
Okay. My initial hope of saving a few $100 by doing this myself is it's gone. I see how trying to save a little on a DIY quote is a recipe for a 6-figure problem. So I need a professional. What's the difference between you, an independent broker, and just calling one of the big national names a captive agent?
The difference is access and motivation. A captive agent, someone who works for, say, State Farm or Allstate, can only offer you one company's products.
Their company.
Their company. If that carrier raises your rate 50% or non-renews you, their only job is to shrug and say, sorry, that's the new rate. They're captive to that one market.
But an independent broker,
yeah,
you have the whole market.
We have contracts with 30, 40, sometimes 50 different carriers. Travelers, Safeco, nationwide high net worth markets like Chubb. Our job isn't to justify one high rate, it's to shop across all of them to find the carrier that actually wants your specific risk, whether it's hail or wildfire exposure.
So you're competing on the quality of the contract, not just the price tag.
We are coverage consultants first.
Yeah.
Exactly. And that's why we created something really unique for this hard market, the custom video policy review.
Okay, tell me more. What is a custom video policy review?
We don't just email you quotes. We know that in this environment, trust requires transparency. Most agents send a confusing PDF and expect you to just trust them.
Right.
We take your current policy, we shop it against our entire network, and then we send you a 5-minute personalized video. It's a real person walking you through your new, quote, line by line on a screen. We point out exactly where those percentage deductibles are, where your ordinance or law gaps are, and what your true reconstruction costs should be.
So seeing a human point to the actual line items that could cost you thousands of dollars, that solves the information overload problem.
It creates clarity and confidence. The stakes are just too high in Colorado right now to settle for some online quote that doesn't even guarantee your home can be rebuilt. Look, you can try to decipher these 50-page contracts yourself, or you can let us do it for you.
So how do they actually get the video review?
It's simple. Click the link in the description right now. Upload your current declarations page. It takes less than 60 seconds. We'll shop 40 carriers, find the shortfalls in your current coverage, and send you a video breakdown of exactly what you should do to protect your home.
And there is no charge for this comprehensive review.
100% free. Click the link, get the quote, and finally sleep better knowing your policy truly protects your legacy.
The only way to win in a hard market is to take control of your information and understand your true reconstruction cost. The goal isn't just a lower rate, it's full replacement cost coverage that protects your home, your family, and your financial future. That is something absolutely worth getting a professional review for. Thanks for joining us for this crucial deep dive.